a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi, everyone. Welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about gold, which has been surging. And gold is up almost 40% over the past 12 months, which is more than double the S&P 500's gain of about 19%. And the precious metal has been rising mainly due to all the uncertainty surrounding trade war and tariffs and massive purchases by global central banks, and then continued volatility in the stock market over the past few weeks. That has also led many investors to seek the safety of gold. Now, gold is currently trading close to $2,900 an ounce, and Goldman Sachs expects they raise their year-end gold target to $3,100 an ounce. And they said that's mainly due to central bank purchasing and inflows into gold backed exchange traded funds, gold backed ETFs. So lately, we have seen some impressive inflows into gold ETFs, while Bitcoin ETFs have lost assets as cryptocurrency plunged over the past few weeks. It has rebounded since yesterday after that announcement regarding creation of a reserve. But gold ETFs have seen nice inflows. And we have also seen that consumers in China and India have been buying a lot of gold, particularly in China, where the economy has been weak and stocks were not doing very well earlier. And talking a little bit about central banks, so gold purchases by central banks have soared in recent years, particularly following Russia's invasion of Ukraine. So US had frozen Russia's assets in wake of its invasion of Ukraine. So that is why more central banks are now investing in gold instead of US treasuries. And they are also trying to diversify away from the US dollar, in part due to rising debt and fiscal deterioration in the US. So central bank purchases exceeded 1,000 tons for the third year in a row in 2024. That is according to the World Gold Council. Now let's take a look at the case for investing in gold. So rising geopolitical tensions and trade war uncertainty that boosts the appeal of gold as a safe haven and store of value. And trade wars and tariffs raised inflation concerns, and gold is seen as an inflation hedge. Uh, and gold generally has an inverse relationship to real interest rates and US dollar. So some of you would recall that last year, in fact, gold had struggled after Trump's election victory because the US dollar had surged and real treasury yields had also surged. Real treasury yields are the yields when inflation is taken into account, because those two are seen as headwinds for the precious metal. Now, the dollar index is now close to a 2-month low, partly due to weaker than expected economic data, and real treasury yields are now at lowest levels since early December. So that has also boosted the appeal of gold. Now, talking about the portfolio diversification, I believe that gold deserves a small allocation, around 5% in a portfolio, mainly due to its diversification benefits. And according to an excellent Financial Times analysis, gold has actually performed much better than bonds as a diversifying hedge in an equity portfolio over the past 20 years or so. And this is the research which shows that gold was a better hedge than bonds in the great financial crisis, then at the end of 2018, and then 2022 inflation and rate-driven stock market plunge. So that is the reason why gold deserves a small place in the portfolio. Now, let's take a look at gold ETFs. So there are some excellent physically backed gold ETFs, and these are very convenient, very low cost, and safe ways of owning gold. And they actually own gold. They are physically backed. They own gold in vaults in London, Switzerland, etc. So you all must be familiar with the GLD ETF, Spider Gold Trust ETF. It is the largest and most liquid gold ETF. But this has an expense ratio of 40 basis points. And it is huge, 82 billion in assets. And because of its liquidity, traders love this ETF. And if you want to learn more about this ETF, you can go to the code page on Zacks.com. You can read our research report articles. You can go to Spider webpage for the ETF. There's not much to learn, though you can read the research, but it is a physically backed gold ETF. Then there are two more gold ETFs which are excellent for buy and hold investors because of their low expense ratios. They're ultra cheap. So State Street launched this mini version of gold ETF, GLDM. This charges just 10 basis points and has 10.8 billion in assets now. And iShares also has a mini version of their IAU ETF. This charges just 9 basis points, ultra cheap. This is the cheapest gold ETF, and this has 1.7 billion in assets. And again, you can learn more about these two ETFs by going to the code page on Saks.com. But they are all very much similar. And apart from the fees, their returns will be pretty much similar, and they track the prices of gold very, very closely. Now, if you want to look at gold mining ETFs, they provide leverage exposure to gold prices. And there are two popular. The most popular one is by VanEck. And this is also the oldest, has 13.2 billion in assets and has an expense ratio of 15 basis points. So to learn more, you can go to the quote page on Zacks.com, and again, you can read the research report and articles. I did a podcast with VanEck a little while, a few months back. You can listen to that podcast if you want to learn more about gold miners and the case for investing in gold miners. And then you can go to VanEck webpage and you can look at the holdings, etc. So Newmont is the top holding. Then you have Agnico, Barrick, etc. You will see that the ETF has a lot of international exposure. Canada is almost 45% of the portfolio, then US, South Africa, etc. So you should remember that with gold miners, you get a lot of international exposure, you get exposed to currency risks as well, and political risks in some of these countries. So all that comes with gold mining ETFs. The second one, which I'm highlighting, is just slightly cheaper, but much smaller too. Sprott Gold Miners ETF, SGDM. And again, you can learn more about going to the code page and from the Sprott web page for this ETF. So what this does is that it tries to identify larger size gold companies with the highest revenue growth, free cash flow yield, and lowest long-term debt to equity. And if you look at the holdings, somewhat different. Agnico is the top holding in the portfolio, and then Wheaton, Newmont Corp, etc. And this also, as expected, has a lot of international exposure, which you should remember. US is just about 18%, rest is all international. On the last slide, I have the comparative performance of all these ETFs versus the S&P 500 index. And for physical gold ETFs, GLD GLDM, and I just included GLD because their performance would be pretty much identical. Over a longer term, though, the cheaper ones are going to do better just because of the lower expense ratio. So you will see that gold mining ETFs did pretty well, but the performance was quite volatile. And as I had mentioned, after Trump's election, these gold and gold miners had plunged because of the rising US dollar and rising real yields. And then they recovered this year again. So with that, the gold miner ETFs are up about 55 and 59%. The spot product has done better. Then gold ETFs, physically backed gold ETFs, they are up about 40%, and the S&P 500 index is up about 19% over the past 12 months. Thanks for watching. Make sure to check out zacks.com/promo for an interesting offer. Make sure to subscribe to our YouTube video channel so that you do not miss anything. And I'll see you next week.